Good afternoon, everybody. Thanks very much for joining us. This is going to be a super session looking at debt and financing. It's part of the Real Asset Live program that we've got here in the International Investors Lounge. If you're joining us online, thanks very much for joining us. It's a deliberately kind of relaxed session, and what we're hoping to do is get some interesting perspectives because we have different views across the panel on what we're looking at in terms of the remainder of 2024 and 2025 and some of those trends and how they're playing out. We will do introductions, brief introductions from me. For those who don't know me, I'm the head of content and one of the founders of Real Asset Media. Our focus is very much on research, analysis, market insight, the kind of things that are going to be driving the markets as opposed to necessarily reporting on what was the last deal. We do cover the news, but our focus is really on where the market is heading. And I shan't tell you about the magazines that we do. There's pictures of them up here, and they're actually on the back. So do feel free to take one of those, and indeed today's copy of EXPO Day, which we run as well. Let's start with introductions. Etienne, let's start with you. So quick introduction of yourself, the company and the area of finance you're in, so that then we can get a sense as we move down the panel of what perspective you're coming from. Etienne.
Yeah, absolutely. Hi, everyone. So I'm Etienne Casara. I work for ICG Real Estate. So we are a pan-European investment manager, active in equity and debt. I'm actually on the debt side, and after the beginning of my career in London, I relocated to Paris. So Paris is our continental European hub, and we invest in traditional loans across, obviously, France, but also Germany, the UK, we're quite active, obviously, and also the Netherlands.
Okay, great. Thank you. Karolis.
Carolis Adlis. I'm with WP Carey, based out of London. Been with the company now 10 years. WP Carey is a REIT out of New York. We've been active for over 50 years. We've been investing in Europe for over 20 years. We are a sale-leaseback player. We are listed as a REIT. We buy commercial real estate, any asset class except office, on long leases, and we pay dividend to our investors.
Super. Daniel.
Daniel Kautenburger-Behr from RSM in Germany. I'm part of the RSM Global Real Estate Group, and RSM advises clients in the real estate industry and mostly borrowers and investors.
Great. Duco.
Hi, I'm Duco Mook. I work for CBRE Investment Management. I'm heading the Treasury and Debt Finance team for Europe, responsible for defining the debt strategies for all the products that we manage, but also execution and management. So definitely here for the borrower's perspective.
Great. So we've got an interesting perspective here in terms of both the investor side, in terms of debt and financing, the borrower side, and also partly the advisory side. So let's maybe kick off with and anybody can take this. So from your perspective, what changes have you seen? We've obviously had the lower interest rates, and I'll pick that up. But what changes have you seen in terms of your part of the market? So briefly, let's start with you, Etienne.
In terms of changes in the market, I mean, beyond the diversification in the different asset classes, so obviously investors willing to divest a bit out of retail, office, and move to traditional beds and sheds. We've seen a lot of investors trying to think about how to reposition some of their existing assets. Part of the previous investment volumes were, office, retail, and more traditional commercial real estate asset classes, and that came with some potential legacy issues, right? So it has always been like, what can we do to drive the NOI performance? What can we do to restructure our existing debt to manage our portfolios, and where can we exit? And we feel at the moment there's still an element of pricing discovery. Where is prime trading? Where is secondary trading? And I'd like to hear your thoughts as well on this. But it's basically the main question marks. It feels like there's more optimism at the moment at EXPO, but I think a lot of legacy issues to go through.
Any other, Daniel, what's your sense? I mean, certainly I can see more of an optimistic view here at EXPO this year.
Well, it's slowly picking up. That's what I would see. And My expectation is that in particular private clients and private investors will pick up. They're getting used to 3.x interest rates, they're getting used to lower LTVs, and I think that will be the activity in the next months. And then it will start with smaller tickets in the institutional market.
Okay, good. Feel free to pick that up, Duco, but I'd also like to get a sense from your side on the influence, obviously, of the change in interest rates and what you're expecting there. What are you building into, I suppose, your models, your plans for next year?
Yeah, before looking at the outlook, maybe first let's take one step back and look back. I'm definitely more positive today, not only compared to 12 months ago here in Munich, but also compared to pre-summer. If you look at 2023, then I think the big theme was liquidity, or in fact the lack of liquidity. Liquidity was scarce for investment managers, for the bond market was closed. That was all a result of, let's say, not only increasing interest rates, but really the increase that went faster than the market was anticipating. Investors didn't have the time to really adapt to that. Valuers had difficulties. They were tweaking their yields, but it really went gradually, and that took lots of time. Also for us in 2023, that was the year that investors that have the so-called denominator effect obviously resulted in redemptions. But this year, that is not a topic anymore. The bond market is open, interest rates have stabilized, we have the rate cuts that started and will continue. And by the way, rate cuts doesn't mean that the swap rates will go down, because I think they're already at the nice low levels. But all in all, you see more liquidity going into the market, you see valuations holding up. So obviously the next point is how active is everybody and do we see the transactions? But to start with, from a liquidity point of view, I think it's a massive improvement, with obviously some realism for most of the parties.
And I remember conversations we had around whether debt was actually accretive at the time for you as a borrower, and decisions around that. What's the position now?
Yeah, that's an interesting one, because we obviously come from an era where interest rates were so low that leverage was extremely accretive, and the main goal of leverage was to boost returns. I think we now live in an era where the number one reason for leverage is to have balance sheet. Either the balance sheet because you have a refinancing loan, or because you have acquired some propositions, full equity, and you now want to get debt in place to maybe continue with your growth. So again, balance sheet is more important than boosting returns. Of course, leverage was slightly not accretive last year, where now probably it is slightly accretive for, let's say, the core and stabilized product.
Okay, good. And again, everybody's being terribly polite, but if anybody's got a view on any of these things, either an agreement or disagreement, feel free to come in. Daniel, just picking up with you, a lot of discussion obviously around the debt gap, elements like that. Do we see with the lower interest rates that becoming less of an issue? Is there still stress in terms of the financing side out there? And I'll pick that up with you as well, Karolis.
Yeah, I would say that there will still be a funding gap in the next year. So there's a lot of debt to be refinanced from the years 2015 following. So debt with low interest rates, high LTVs, and I would expect that some of the gap needs to be met through capital restructurings or asset sale and someone accepting a loss. And once the sellers will accept losses, then I would expect more market activity again.
Okay, so you see that coming through. And Karolis, from your point of view, is that still driving uptake of sale and lease back in terms of people needing to find that financing?
Yeah, and maybe I'll take a step back as well. I think I'm the least positive guy here on the panel. I'm typically tend to be the most doom and gloom guy. I think when we had the runaway inflation and then rates were going up, and it takes 12 to 18 months for the higher rates to filter through the economy, and now we're starting to see, I think, real pressures in the economy. And I know some people are more positive than others, and I'm maybe more negative. I think now we're starting to see pressures on the business side, where they're starting to struggle. And if you see central banks cutting rates, it's typically a sign that the economy is underperforming, because you need to stimulate it with lower rates. It's not the fact that the economy is now great and let's cut rates back. So we actually now seeing more opportunities to do deals, sale-leaseback deals, because sale-leaseback is essential alternative tool of financing. And we're seeing that for the companies who are either struggling to refinance or they're in restructurings and they need a little bit of money, which we try to free up through their otherwise illiquid real estate. So definitely an uptick in the transactional volume we see on the sale-leaseback side.
Okay, good. So that is definitely half empty.
No, it's
Good point.
maybe it's more negative on the economy side, but it's more positive for the real estate investors.
Okay, good. Let's pick up with you. I mean, that's interesting because we're looking there at some of the concerns, some of the challenges. Etienne, so let's pick up with you on that. I guess, what are you seeing as the challenges in this part of the cycle?
Well, I would say the transaction volumes are down, so automatically there's not much trading at what we would hope would be a rebased valuation. So meaning entering at a decent price. So we see a lot of legacy transactions in need of a restructuring. So existing debt, that is in play, that is to be refinanced. But ultimately, the business plan went underwrote at a time when people were expecting a 3% cap rate on exit. So when we look at the look forward, you can look at IRR, you could look at the yield on cost of a given asset for development, it's still fairly tight compared to where prime is trading at the moment. I wasn't mentioning, we're still trying to understand where prime is, and it seems there are some trades in that space, maybe core plus investors trying to take a view on future inflation for the best locations in Berlin, Paris, London. But when we hear about trades in that space, it's mostly, sometimes 4.5%, 5%, so nowhere near the 3%. And the main question which comes into play as well is where will be the secondary trade? So when it's not, an A location, but more B location, an A sponsor, etc. So that's the tricky bit we see at the moment. So understanding all of that, and the point was made, someone has to take a loss, or very expensive equity has to come in, which has the same effect.
Okay, good. It will be interesting to pick up on, I think, the availability of finance, what is being financed, what is not. I'm so happy to hear from anybody on that. But let's start with you from the borrowing side. In general terms, what are you seeing as availability in terms of financing? It may well be obviously that CBRE is a preferred borrower, but what are you seeing in the market at the moment?
Yeah, I think for core stabilized prime, what's prime? I'm with you there, but let's say the conservative banks, they are very selective, right? What that means is that every new deal needs to tick all boxes. It's not only the real estate, but they look at the sponsor. They look at potential side business and profitability. They look at the ESG credentials next to the asset class and the country and all the LTVs, etc. It really needs to tick all boxes, and otherwise they will pass, and you might be left with empty hands. So I think for the right product, there you even see more competition coming to the market. But again, all these elements matter. Size of the loan has become much more important. If it's too sizable, they don't dare to make an offer, or you end up with multiple banks. If it's too small, it's not profitable enough. So it's really need to be that sweet spot for those banks, and then the competition is there.
Maybe I'll add one thing, definitely echo that. I think from the investor side, what we see when we bid on deals, and WP Carey is an all-cash buyer. We don't use asset-level financing, we issue bonds. And in a lot of process where we bid, we typically, when you talk to agents, they say, well, we have buyers that bid tightly, but they need financing. We kind of don't really trust these buyers, and we're only going to consider buyers who are all equity buyers, because getting debt is difficult, or more difficult, especially if you have timing concerns.
Okay, good. And just from your perspective, Daniel, I suppose, what are you seeing in terms of availability of finance? And also, how do you see that over 2025? Do you expect that to increase? I mean, interesting that Duco said that there was actually beginning to be more competition coming into the market.
Yeah, I think Duco summed it up very perfectly. Banks are very selective. In particular in Germany, financing real estate relies on banks. So banks are very selective. They're looking on the product and sponsor. I think there are opportunities for investors who have the cash and who have a good credential. It's not more to say than Duco said already.
And what are we seeing in terms of the cost of borrowing? I mean, are we expecting that to continue relatively high? What's your expectation, Duco, on that?
So a couple of years back, when the interest rates were zero or negative, then the main factor was the margin. Now nowadays it obviously has turned. The margin is important, but the base rate is more important because it's obviously a bigger element to it. So if we look backwards on a relatively short tenor, then a year ago the swap rates were 1% higher. So obviously from that perspective it has improved. I have not seen a real improvement on the margins, to be honest. I think most banks are struggling with in-house liquidity costs that went up. Some might have allocations to the US, increased write-offs, non-performing loans, etc., which ultimately has the same result, margins going up. If you look back a bit longer, then obviously if you need to refinance now and your 5-year loan is maturing, then your cost of debt might have tripled, or might triple in fact. So I think still that the refinancing risk is a very big risk. It might be even the biggest risk for the current market. But again, in the last 12-18 months, obviously it has improved.
Okay, good. And just in terms of, I suppose, if we turn that around to being where the opportunities are for a second, does that mean that sale and leaseback becomes a more attractive route for some, because it's a different form of financing coming in a different way? And I know you'll both have a view on that, so it'd be interesting to pick up with you, Karolis, and then Etienne for you.
No, 100%. So what we're definitely seeing is an increase in demand of sale leaseback from private equity owners. A lot of deals we see, especially in Europe and Southern Europe, with private equity companies.
So specifically from private equity?
Exactly.
Okay.
Private equity companies who want to refinance the debt on their portfolio companies, or who try to acquire new businesses. And they typically use a sale leaseback as a financing tool to either acquire new businesses or to refinance short-term debt on the business they just bought. So definitely an uptick in that segment.
Okay, good. Etienne, what's your...
Yeah, well, I'm on the debt side, but we have a sell and leaseback strategy, and the way we approach, the market as well is it's a useful tool for corporates. There's some liquidity in there. There's actually big players because ultimately the ticket size, you spend in the market is actually quite sizable when you think about it, and when you think about what you can get from even banks at the moment. So we feel that we've seen some scenarios in which private equity sponsors bought into some corporates and they want to realize, and the only way for them to get some sort of distributions at some point or to fund the business is through sell and leasebacks. And those corporates aren't really, obviously, the savvy investor, obviously, but at the same time, they're not going to care about the 25 bips, which is going to make a difference, but which can make a difference for us. And on the other hand, the liquidity in terms of financing for long lease assets has been, pretty decent, I feel, particularly compared to the more speculative end, I would say, of the spectrum.
I was just wondering, do you, looking at the recession we have in Germany and low growth in Europe, do you see more demand in sale and leaseback from corporates?
Well, we do see a lot, to be honest, and actually some of that we do it directly in the value add fund because ultimately the risk returns are pretty good. When you think about an SME selling a 20, 30 million asset and assuming you want to do an aggregation play, then you can literally buy at, we think, very attractive basis and strong yields in the market.
And I wanted to examine a little bit the capital stack side as well. I mean, are you seeing, Daniel, more whole loans? What's happening in terms of mezz financing? Because obviously that was slightly underwater last year. So I guess, how is that playing out at the moment in terms of both the financing side and the borrower's side? Just looking at how they're financing those parts of the capital stack.
Well, what I see is, I have a very German view on this. In Germany, it's mostly bank finance, and looking at mezzanine, I would say the mezzanine of the last 7, 8, 9 years has taken a hit or will take a hit. So I'm wondering what the colleagues will say about availability of mezzanine. Currently, I would say it's very difficult to get mezzanine.
Yeah, well, if I can comment on this quickly, we see actually a lot of requests, but even our competitors aren't really active in the space anymore. We see actually people doing whole loans, and we do think as well, we're on the same view as well. It's a simpler product when you think about it. It's only one party, one-stop shop. You advance the whole loans for the sponsor. And what we've seen, about mezzanine products is when you have to restructure those, it's quite complex. You might, trigger red. You might need a change of control from your senior. Ultimately, when we were doing mezzanine, that was, let's say, from 55% LTV to 70%. And so the senior was 0 to 55. And so when you think about just the size, it's 4 times as big of the ticket we did. I'm happy to invest 100 million, but I don't have 300 or 400 to take out the senior. And so we see a lot of situation being stuck because of that right now.
If I may add to that, I agree. I think we have seen many alternative lenders being very active in today's market. I think they have the liquidity. I think the LPs in the last few years preferred credit over debt. So they have the liquidity to deploy, and they can be very selective in today's market. Now, from an alternative lender perspective, the returns are already very decent. So why would they offer a mezz loan if they can get a bit of security and it's a junior loan for pretty much the similar returns? And then probably the same next step is better to provide a whole loan to make it more profitable as well and to make it the bigger tickets. It's something that we see as well, absolutely.
Okay, good. Where do we think the majority of the funding is going to come from? Is it still going to be largely the banks? Are they slightly constrained by refinancing? So I guess, what are we seeing in terms of the makeup of the market? I don't know if anybody wants to pick that up.
Well, on the equity side, I think, again, 2023 was very tough. 2024 looks better. It does not come from a specific pocket. I would say those type of investors, again, that were facing the denominator effect last year, have their house in order this year to be, again, looking at investing. That's the pension funds and the insurance companies, typically. Although with a global view, so it could be the Dutch, it could be the French, but again, could also be the US. It is more traction with these investors. We see slightly more inflow. It is expected that will continue and will increase, but gradually. So it's absolutely not at the volumes of, let's say, a couple of years back, but compared to last year, a big step forward.
Okay, good. Does anyone else have a take on that? No, good. Let's pick up on some of the elements of financing as well. Development financing, that was an issue a year ago for sure. And in fact, a lot of the equity investors were stepping in to the development side in order to get a lift in terms of returns. What's happening now? Is development finance still difficult, still a kind of casualty? Does anyone have a view on that?
Well, also, again, very German perspective, looking at the German market, I guess.
That's allowed, Dan, because you are from a German perspective, so that's fine.
It's, I think it's still difficult for developers currently, in particular those who had acquired the land in the last couple of years, where they had high acquisition costs for the land and inflation-driven the construction costs. And although they're in the residential market, there's a need for construction. There's still an uncertainty whether you will get rent control and other regulations. So it's still very difficult.
And Etienne, I think you're involved in some development finances. So have you got an alternative view, i.e. is it challenging but rewarding because there's less people in the market? Or what's your take on it? Are you still lending in terms of development?
Yeah, I think it's our perception. So I would say you can feel that the banks aren't there or supporting their existing clients. So although some developers have actually very profitable projects in the resi space, it could be in the logistics space, we feel there's actually a gap to be bridged there. And ultimately the way we approach the market is basically trying also to, instead of them going for some equity from the value add funds and you pay 20% on that equity, trying to provide that in the form of a whole loan, but we cover almost the mezz part. So we can go very high in terms of loan to cost, which I think it's quite advantageous for some of the sponsors, so up to 75% LTC sometimes. And the way we see the underlying business plan, ultimately, I wouldn't say building a shed is easy. There are a lot of risks when you do constructions, but those risks can be mitigated. And the lease market is so strong that you might be lucky with a pre-let, but you can also, complete the building and lease it up, so build on a speculative basis do great returns, and the cost of debt, doesn't matter much in the, compared to the whole profit of the deal.
Okay, good.
Maybe I'll add. I'll echo Daniel, because what we see is in the build-to-suit project you have construction costs fixed, so you can either move the rent or the yield. The yield is driven, the cap rate is driven by the cost of money. So what we're seeing is massively over-rented assets being brought to market. And when the developer tries to get financing for the build-to-suit project and tells the tenant, look, this is the rent you're going to have to pay, a lot of tenants actually decide to delay the build-to-suit projects at the moment.
So it's creating a lot of delay in the market?
Because of the construction cost and the cost of money, the rents are just too high and makes unviable the projects. So definitely we can see that.
Okay, interesting. Let's also, I suppose, pick up a little bit on, one of the concerns last year was just how do you underwrite values? Because it was a challenge both from the lending side as well as the equity investment side, because if buyers and sellers couldn't agree on a value or there was such a difference, that seems to have changed. So does that make underwriting more easy? What are the challenges there? Is that a change that everybody's seeing?
Well, we are seeing that the repricing following the yield shift is bottoming out, definitely. Probably the UK is a bit ahead of the continent. Maybe not all the countries are aligned, but overall, the differences between the Q1, the Q2 and the Q3 valuations for this year, for let's say the traditional 4 asset classes, have absolutely bottomed out, yes.
I don't know, what we're seeing in terms of valuations, active markets, is typically the markets that were not as tight are the ones that are more active now, because they had to shift least to still work with the new cost of money. And the markets that were tightest, like Germany, we see least amount of volume because it's just too big of a gap to bridge between the previous expectation of the sellers and the new cost of money. So for example, we see Southern Europe a lot more active now than the countries like Germany or France.
Okay, good. Be interesting to pick up a little bit, drill down into some of the sectors, because obviously we can see that sounded like something had just flown straight across here, but I don't know if it was. Oh, that might be me. Maybe you're coming from there. Not coming from us. It's coming from there. Okay. All right. Well, nothing we can do about that, except maybe just get excited when it happens again. I don't know. Let's pick up a little bit in terms of, I guess, some of the sectors. What can be financed? What can't? Is it more difficult to get financing for office, for example, now? Is it more difficult? Has it changed for retail? So where are we seeing the financing? Where are we not? Obviously, living sector is very popular, but does that mean we're also finding it more difficult in the more operational side of things, whether that's student or whether it's senior living, for example? So just any takes that you've got on the sectors and how you're seeing those, really, whether it's what you're prepared to lend on or whether it's what you're looking to borrow on and the enthusiasm for that product.
Maybe I'll comment very quickly. Where we are most active recently is we are a sale-leaseback provider. Essentially, it's alternative tool of financing, but we have a lot of sale-leasebacks with industrial companies for proper manufacturing assets. A lot of banks tend not to like that or not to want to lend on it. And that's our sweet spot, because you get a strong credit, strong company that's been running that side for 50 years. They're never going to leave. They've been manufacturing whatever they make. Essentially, it's the core of the business. So we actually are most active in the segment where banks don't even want to be active, because for us, that's the most safe investment.
Okay, good. Any other?
Well, I can talk about ICG very briefly, but we're basically active in beds and sheds and data center as well. So, along the key themes, urbanization, digitalization, and the green transition. I don't think we've spoken about ESG yet, but I think it's usually a topic on any panel. And well, people might think it's always the same, but within living, first of all, you have different types of living, right? It could be co-living, it could be senior housing, it could be anything else. Your typical residential projects, and so we feel there's a lot to be done there. The market is not mature when it comes to alternative sorts of living, but we think it's moving. And there's probably an element of repurposing some old offices, but particularly in secondary or tertiary locations, which should happen. It can take a bit of time. Planning is not easy by no means. It's complex on the debt structuring, but we're trying to look at any of those projects when they make sense, beyond your typical asset class.
Okay, good, and that's very nicely teed up actually. A discussion on sustainability, which I do want to pick up on, but also the session following this is going to be around ESG, sustainability, and then we're going to be looking at living and then student housing. So you managed to introduce all of that for me, Etienne, which is great. Any other takes on the sectors?
Well, happy to comment. So what we have been hearing from, let's say, the traditional lenders, the German banks, but also the international corporate banks is, of course, logistics and residential. But you also hear then that in the last 12, 18 months, they definitely had revisits their strategy, and next to increasing allocation to the resi and the logistics market, it was also a clear topic that the niches linked to that became more in scope. And when I say the niches linked to that, I mean rather than only buy to hold strategies, maybe also consider buy to sell, or rather than only the residential apartments in the top cities, maybe also the elderly homes, maybe the student housings. On logistics, typically data centers is mentioned. I would say quickly on the other asset classes, shopping centers, including retail, sentiment absolutely improving. We have also refinanced shopping centers with other lenders this calendar year. That is best in class, that is low LTVs, but it's not a policy point anymore to not increase their allocation to retail. So I would say a good positive note. Offices. Of course, the sentiment is poor on the investor side, on lender side, absolutely. For those with an allocation to the US, it's obviously more constrained than without. But for best in class, and best in class is London CBD or Amsterdam South Exit has been traded, there are conservative banks financing that. I can only imagine that the LTV is not higher than the 50-ish, but there is liquidity for that on both equity and debt.
Okay, good. I wanted to pick up the ESG sustainability side. Quite a move in terms of the market, both in terms of how it's discussing it, but also actually that it's becoming more an operational part of and a given element for both the investors, the occupiers, the borrowers. I guess what role is finance playing that at the moment? Green loans, those kinds of things. How much is that driving it at the moment? Maybe start with you, Etienne.
Yeah, sure. So, on the ESG front, the way we approach, the market, ultimately, we think beyond the commercial and financial, opportunity that real estate is. If we can have and help the sponsor get to the best, ESG credentials, it's a good way to get improved liquidity on exit. So less time on the market. As we know, assets can stay for some time on the market before they get to the required price. So that maximizes, we think, the outcome. And the way we approach it is we produce tailor-made facilities. So we agree some milestones, so predetermined milestones with the sponsor. It's part of the due diligence phase, and it's baked into the documentation. We obviously monitor all of that, and the way we incentivize sponsors, because we want this to be a win-win ultimately, is we can provide a ratchet down in terms of margin. We can waive sometimes extension fees, so we link those ESG milestones to a financial outcome. Everything is, based on a commercial discussion. Obviously, we don't want to be too prescriptive in the sense that it's not realistic and that won't be implemented. We really want a collaborative approach. But generally, as a firm, we think ESG is not just about energy savings. It's biodiversity. It could be a more circular economy. So how do we transition from the current economy to a more circular economy? It's all of that, and apply to developments, but also standing assets.
And Daniel, do you think that's going to give preferential rates going forwards? I guess, do you see this now becoming an integral part of the financing market?
Yes, we see it coming because, as Etienne said, banks are looking at exit, banks are looking at refinancing in 7 to 10 years. So already today they take a look at the ESG side of the financing. So it's already here. Yeah.
And Duco,
it's absolutely, it's embedded in the whole market, I would say. On the lender side, you obviously had the first movers a couple of years back. But since the regulator, so the ECB, actively pressured all the banks to increase their green loans, to really have a strategy and really come up with a game plan to get an increased allocation on green or sustainable loans in a certain time period. I think that was quite decisive in the lending market.
And does it give you preferential rates? Does it give you easier access to certain sorts of financing? Are there advantages for you as a borrower?
Well, I think ultimately it's going to be black or white. I think a brown asset without a clear brown to green strategy, including business plan, including a sufficient budget for the capex and what have you, will ultimately not be financeable.
And is this part of, I mean, I'd be interested to get from you, Karolis, I mean, you mentioned that there was a lot of refinancing private equity, but what about, I guess, owners of some of these maybe smaller assets that don't have access to some of that financing? Is that something where they're looking at having to refinance in some ways, and so sell and lease back is an option to be able to support that transition for them that they need to do? What, is that something that's coming up or not?
So maybe a couple of things I'll mention on the whole ESG initiative. So, of course, you want to buy buildings that are ESG friendly, right? That allows you to issue green bonds, which provide you cheaper financing. But if you do a sale leaseback for a manufacturing plant that is more than 50 years old, that the company's been there for many years, it cannot always be ESG friendly or environmentally friendly because it's manufacturing. By definition, it's not environmentally friendly. And we love those deals because it gives you security on investment, security on the tenant staying there. On the fact if tenants do sale leaseback to finance environmental initiatives, no, typically sale leaseback is not a tool to do that. But what we see a lot of our corporate partners who we do sale leasebacks with, we do finance their green initiatives. So, for example, for quite a few years, Carey owned the largest solar roof in Europe on our asset in the Netherlands. So, for example, we did a sale leaseback with a tenant who then said we want to improve our energy efficiency, and we finance their solar panels. So it's an add-on you can offer to your partners.
Okay, so people are using it actually for capital expenditure.
Absolutely.
Okay, interesting. And maybe we're kind of coming up to the end now, so if anybody's got a question or a comment, now is the time to make it. Let me say, yes, go ahead, yeah. I'll pass you that.
Thank you very much. What I miss in the discussion is the political risks in financing, earning stripping, and also the role of supervisory authorities regarding solvency issues and developments in that. Can you elaborate on that a little bit? What it means for the capital market?
Great, thank you. Any others? And then we'll take more at the same time. That was quite a good question, so let's tackle that. Does anybody want to pick that up?
Steven, I couldn't hear the question.
I couldn't hear the full question, yeah. Political risk?
Yes, it was really...
Yeah, political risk and solvency issues from the authorities, and also earning stripping, what's going on, especially in the Netherlands, what's going on in Europe. Limited
Yeah. No, absolutely. Well, so, I mean, first of all, talking about the debt product, the good thing about doing whole loans, we have first ranking securities, right? So we even come before the taxman, we have a mortgage on the properties. So the way we approach the market at the moment is we've seen a rebasing on values, bank retrenchment. So sometimes we can go with even lower LTCs and generate higher returns that we were generating two years ago, and being totally shielded from the tax risk. So we think it's quite compelling. Obviously, that doesn't apply to the equity, but on the debt side, we feel it's quite compelling. Beyond this, like all the legal frameworks, we hear about rental caps. Generally in Europe, it's difficult to build, let's face it. We don't have the same dynamics as the US. So all of that seems to be more headwinds than tailwinds when we look at it. But those headwinds, we've had them for quite some time.
Come with me, come up.
Yeah.
Then we can be absolutely sure that we hear it.
Yeah. Because your cash flow will be influenced by earning stripping. You can't deduct anything. EBITDA is not free anymore because you have to pay your taxes.
On the full amount, yes.
Liquidity has been limited. And depends on yesterday there was an article of ING, and it said, well, for housing it's more bad than for commercial real estate, because if you look at the net initial yields of commercial real estate, it's higher than for housing. So, and if you may only use the 25% hurdle, like it's in the Netherlands, you're familiar with that thing, then you have less liquidity for your debt service. And my question to you is, how do you view it? How do you take that in your decision?
Great, thanks, Jan. I can't help feeling I should have asked for that question earlier. Duco.
What we definitely see is that lenders are downsizing the maximum debt quantum, the maximum loan amount, based on cash flows. So rather than in the past the LTV was decisive because it was a policy point to maybe go up to 60% LTV and have a bullet loan no matter what asset class, now they're downsizing based on the debt service that can you pay. So in fact, that might lead to a product on, let's say, a resi scheme that the maximum LTV is 45%, where maybe on a retail scheme they would go to 50 or 55. So lenders have a different approach. RCR is leading there and absolutely cash flow driven.
Great, any other views on that? Otherwise, quick last one from me, which is, what is the biggest trend that we're going to see? And I will check this at EXPO next year. What's the biggest thing that we're going to see in the financing markets for the next 12 months? Biggest, most important thing?
Hopefully the improvement of the cost of financing.
Okay, improvement in the cost of financing. Etienne?
I would say redemptions or investors willing to see more realizations out of portfolios. We can feel the pressure, but it's coming even harder now, and that should drive volumes, but probably not at the pricing people would expect.
Okay, Daniel?
I would also say once current investors accept the losses they now have in their books, but they don't realize by sales, once that is realized, there will be more dynamics in the market.
Great, and last word to you.
Maybe 2 points. On a negative note, I would say, of course, we will get rate cuts. But mind you that the long-term base rates are extremely low already and are not likely to go down. On a positive note, I think if the transaction market picks up a bit more, then we will also see with lenders, we will see more competition for the right product, for the best in class. We will see more price competition, and also the margins will tighten a bit, which is also followed by what we currently already see, quite an aggressive and active bond market where the spreads are quite low, definitely compared to last year. So all in that, I think we will see more cost of debt, a positive cost of debt for next year.
Okay, great. Very interesting to get your take on that, I think, to get your views in terms of the financing side. Really interesting perspectives. Thanks very much for your questions and for being here for the discussion. And thank you as well to everybody who's been watching online. And if you're watching this on demand, thank you very much for watching.